So I'm talking about Ankit Agarwal, who is the managing partner at Alteria Capital. Now, for those of you who may not know Alteria, they are India's largest venture debt fund. Should all founders even raise external money? I mean, when should they consider it? What kind of ventures are actually right for equity and for debt?
So I think it's an overused, somewhere abused word that a startup is a startup when you are kind of valued by an investor and it had raised funding. But most of the successful businesses, if you would have seen, would have not have raised any external funding for many years in the start.
People, entrepreneurs raise fund just for the validation, just to get into that club. But the mindset should be really to build a sustainable business. How do these loss-making companies who are burning cash over the day, I mean, how do these companies get billion-dollar valuations? I mean, so many investors ask me, यार profit कहाँ है? कैसे इसको valuation दे रहा है? I mean, so what's really behind those numbers?
I think failure is not a taboo anymore.
So on an informal note, एक बात बता भाई, Zepto क्या हमारे छगनलाल कैंटीन वाले पावभाजी से पहले डिलीवर कर पाएगा?
I think that would have been tough.
What is that one biggest mistake founders make while chasing funding?
I think for me the biggest one will be listen to your customers before you listen to investors. I think one thing is for sure that given we are very blessed to be in a country like India today, if you are a great entrepreneur, if you have a great business, there is no doubt of capital.
संगित भाई, आज इनफॉर्मल वाला इंट्रो दूं, तेरा एक्चुअल इंट्रो दूं कि फॉर्मल वाला इंट्रो दूं आज?
यार आज वो फॉर्मल स्क्रिप्टेड वाला दे दे प्लीज.
Alright. Okay, friends. So I'm talking about Ankit Agarwal, who is the managing partner at Alteria Capital. Now, for those of you who may not know Alteria, they are India's largest venture debt fund and one of the most active capital providers to the high-performing new age startups. They are managing an AUM of more than 4,500 crore domestic AUM with a team of more than 25 people. They have deployed more than 8,000 crore amongst 250 plus startups in last 8 years via venture debt funding. The best part is that their aggregated losses is not more than even 0.5%. That's way lower than what even the banks report to you as the NPA numbers. Alteria has worked across sectors like consumer, healthcare, logistics, SaaS, AI, fintech, you name them all. They've backed some of the household names today like Zepto, Bluestone, Country Delight, Aether, and so many more. They are a SEBI-registered close-ended fund, raising capital from some of India's biggest institutions like the banks, your insurance companies, large family offices, even Premji Foundation, SIDBI, and IFC. And of course, why would their investors not love them if they end up giving you somewhere more than 16% kind of a return with a mix of fixed income stability and equity upside? And again, for those of you who are hearing me for the first time, my name is Hitesh Jain, and I'm the founder CEO of Finomatic Fintech, and we are a wealth management firm. So welcome to my show, Ankit. I love to host you today.
Thank you, Hitesh. Thanks for having me here.
All right. So we have known each other since childhood. Ankit, honestly, back then, did you ever imagine that you would end up building something like Alteria Capital? I mean, were you just focused on how do you manage tuitions?
Truth be told, I was just focusing on timing cricket right after school for my terrace cricket. But apart from that, I think honestly, what I personally feel, and that's true for most of us, that what we end up doing or becoming, a big role is played by our conditioning and environment that we get while growing up. I feel I was extremely blessed by the support from my parents, my school, and friends like you, which just nurtured me to have aspiration to kind of do something different, do something big. When my father and his family came to Calcutta many decades back from a small town in Rajasthan, they had nothing in their pocket when they came to Calcutta, and they became small entrepreneurs with a huge dream and aspiration in mind. And I think that's the kind of stories I grew up with. Right, I was seeing many young entrepreneurs kind of budding around me, and who was always thinking about big ideas, big dreams. Who were great at preserving, conserving, as well as growing money. So I think that's like your DNA, right? You grow up with that, and you keep thinking about the kind of opportunities that you've got, how to make it big. So I think it all goes back to the roots for me.
Wow. I think it's amazing. I mean, how dreams evolve, right? I mean, some kids dream of cricket, some of becoming doctors, and a few like you, the smarter ones, end up shaping India's startup ecosystem. All right, so Ankit, share one memory from school or college, which might be mischievous or it can even be serious. And don't talk about your girlfriends that actually shaped your entrepreneurial mindset.
I think I'll go back to the roots, right? I think I'm quite blessed to have grown up in a Marwari community where everybody had, very entrepreneurial mindset. And I remember my father's business was into textile trading, and somewhere the business used to run on credit, and somewhere you end up backing your fellow smaller entrepreneurs around you because you're essentially supporting everyone by giving credit, and everybody's small, everybody's nurturing the ecosystem. And somewhere I'm doing the same, right? I'm just with a little bit more fancy jargons like valuations and VC funding. I am also backing entrepreneurs with capital, with larger dreams and smaller businesses. And I think it goes back to that, like going back to like, especially like a city like Calcutta, we've grown up hearing great stories, great entrepreneurs coming out of Calcutta. And I think it's always stayed with you, right? It always kind of keeps you going.
मतलब हमारे खून में ही है, हमारे डीएनए में ही है.
Absolutely. And that's what I hear from people when I go back to Bombay that, अच्छा तू कैलकाटा का मारवाड़ी है, that's why ये तो ये कर रहा है.
Fair enough. So, Ankit, I remember all the samosa stories that we used to have in our canteen, school canteen. But let's talk about the new age samosa, which is the venture funding. Every founder wants a bite today, right? So, my question to you, Ankit, is that should all founders even raise external money? I mean, when should they consider it? What kind of ventures are actually right for equity and for debt?
I think, look, short and obvious answer to this is a big no. Not every business and every founders should raise external money. And I use a certain kind of framework whenever I am asked this question is the three big words. One is risk appetite, the nature of business, and the stage of funding. Coming to risk appetite, I think, do you want to become a founder who wants to kind of run slowly, run longer, want to build gradually, but wants to preserve 100% ownership of your company and wants to completely control the destiny? And your business doesn't require a lot of funding for it to grow. In that case, you should not be raising external funding. At some point of time, you'll start getting bank debt funding to grow your business. That's how 95% of the business globally have always grown. They have not grown on venture funding, right? So I think one is risk appetite. That do you want to, and you have the risk appetite to run extremely hard, extremely fast, or you want to take it slow and you want to run it at your own pace. I think that's risk appetite in some ways. Second thing is, I think the kind of business that you are building. Certain businesses has operating leverage modes which require very fast and large infusion of capital for this to become big, and business starts making sense only at a certain scale. So those kind of businesses require a lot of, especially equity funding at the start, because the assets that you need to build for funding are not tangible collateral assets. You don't get conventional debt funding for those kind of companies. Hence, you require very fast and early stage of equity infusion. For example, if you're building a consumer platform like a Zepto, or you're building a SaaS company where you need to just hire the right engineers at the start, your revenues and profitability come after many years. In that case, funding is extremely important. But if you're running a company which has a strong product and you come from a great background in a certain industry, in that in the first 4 to 5 years, you can just run your business on your own credentials, your own network, and then build it slowly. Third, I think is stage. I think certain businesses require funding right at the seed stage, where the product building takes 2 to 3 years, team building takes 2 to 3 years, and idea validation itself takes many years. In those kind of businesses, I think funding is required right at the start. In some businesses, uh, the binariness is not there right on day zero. In those cases, once you build your business 4 to 5 years, get to a certain revenue, certain profitability in your business. In those cases, you just look at growth capital rather than idea stage capital to make it work or not. So it's all comes down to the risk return appetite on at what point of time is it making sense or not. So I think it's an overused, somewhere abused word that a startup is a startup when you are kind of valued by an investor and it had raised funding. But most of the successful businesses, if you would have seen, would have not have raised any external funding for many years in the start.
Correct. मारवाड़ी अपना पैसा किसी और को देता नहीं है. So I think what we're fairly said, Ankit, that I mean, raising fund is not the prerequisite for every startup, right? I mean, sometimes people, entrepreneurs raise fund just for the validation, just to get into that club. But the mindset should be really to build a sustainable business. Fair enough. So just like not every kid would end up becoming a cricketer, not every startup would end up raising funds, right? But tell me one thing, Ankit bhai. I mean, when you hear a deck, when you hear a pitch, what makes you feel like यार ये बंदा तो समझ में आ रहा है? What are those 2-3 signals on the basis of which you said कि यार इसको पैसा देना बनता है?
Yeah, over the years, I think when I got into venture funding a decade back, right, I always used to think that it's always about that great out of the box idea that kind of makes it work. And the investors who have done this long enough had always mentioned it initially and for a very long point of time. It's about the founders which matter. And over the period of time, I've also realized that why is that the case, right? When you're building something very new and disruptive, right? The things around you will keep changing extremely fast. I have seen businesses which are extremely large, profitable listed companies now, but they have pivoted at least 10 times in last 15 years, right? Which means that the most important thing is founders' resilience. I think, do you have it in you to just to keep backing your own idea, keep backing your team, keep backing yourself, most importantly, that, when things are not right, you just make it work. Sometimes you need to pivot your business model. Sometimes you need to go to a different market. Sometimes you need to acquire a different company just to make it work. Which means that the most important attribute that we see is founders' resilience. I think second is also sometimes while we talk about product market fit, there's something called founder market fit. Are you the right founder for a certain business idea? If it's an extremely wacky out of the box idea, sometimes we want someone who doesn't belong from the industry. And if you look at Adit from Zepto, right, he had no background. He was a 20-year-old guy with he was a kid, right? And still a kid, and he had a vision of like larger than most of the large listed entrepreneurs in the country. But you needed someone who did not have a baggage of the fact that quick commerce or any grocery delivery models have not worked successfully in India for the last 10 years. So most of the guys dared not to dive into that kind of a business model. But somebody who had no baggage could do it. Sometimes we need younger entrepreneurs, but for some business models, like let's say a wealth tech kind of a business model, right, or a SaaS business model which has a B2B element to it, sometimes we look for entrepreneurs who have done this long enough to understand the issues and the rewards that come with it. So I think the founder market fit is important. And last, I think that not the least is the founder inspiring, right? And initially, it's I think a very unsaid word. And when you say inspiring, you're inspiring everyone around you. You're inspiring your investors. You're inspiring your customers. You're inspiring your team. Because at that point of time, everybody is trusting you. Your first team member is trusting you. Your first customer is trusting you. Your first investor is trusting you. So do you have it in your personality to keep inspiring? Because that inspiring quotient doesn't end. You need to keep doing that. Today, if you look at Deepinder, right, it's a large bet is still on Deepinder on Zomato, right? Because he's extremely inspirational, he's extremely long term thinking. So I think these 2-3 attributes as a founder is something that we keep looking for.
Fair enough. So basically, investors often back the founder's conviction than the business idea in itself. So I mean, listening to you, I feel it's almost looking like the way our teachers used to judge us. I mean, some of us had marks, and some of them had just confidence. But seriously, I want to ask you one question, Ankit, here that how do these loss making companies who are burning cash over the day, I mean, how do these companies get $1 billion valuations? I mean, so many investors ask me, यार profit कहाँ है? कैसे इसको valuation दे रहा है? I mean, so what's really behind those numbers?
Sure, it's definitely the most asked question for us, right? I'll give you a very loose analogy for it, right? If you look at any real estate property, right? The first investors who typically bet are the ones who are building on the developer, where even before sometimes the land is bought, right? And when sometimes the land is bought and there is some construction that started, some more investors will start buying those properties. There's no property, there's no rental coming out of that. You're not started staying. when the property is built and when people start staying, at various points of time, investors start coming in, right? They come at various prices because everybody essentially, some people are betting on future, some people are betting on what they see in front of them, right? If you look at, if I'll just replace a real estate property to an intellectual property when it comes to startup, right? An intellectual property is your customers, your brand, your product. Everybody's of course betting on the future. At some point of time, there are extremely large pools of revenues and profitability which will drive the value of the business, right? Now today, if I'm coming at a pre-series A or a series A stage terminology in a startup, I'm of course looking at after 8 to 10 years what this company will become, right? That's a risk and reward that comes with it, which is why the kind of capital that comes into the startup ecosystem comes with a very nuanced understanding of that risk and reward from investors like us, that we understand and we put a certain probability of what will work in the future, right? uh, some work, some doesn't work, but that's how the ecosystem works. But overall it's great for the ecosystem, great for entrepreneurship, that we just create more and more entrepreneurs. And most importantly, I think failure is not a taboo anymore. We've seen founders who have failed 2 times, 3 times, and ended up making extremely big in the fourth time. So I think losses are the way to look at losses. Are these are initial investments into creating intellectual property with a hope to drive extremely large profit pools in future.
Fair enough. So I think it's not just about today's profits, but about the overall dream, what the overall size of the market, or what's the overall opportunity that would actually make you think about that particular idea. So it's just like it's not about your today's marks, what your kid is getting. It's about the future potential. So speaking of potential, I mean, you spotted Zepto, Mokobora, even before many others would have even heard their name, right? So on an informal note, एक बात पता है भाई, जेप्टो क्या हमारे छगनलाल कैंटीन वाले पावभाजी से पहले डिलीवर कर पाएगा?
I think that would have been tough, but yeah, but yeah, these are like two great examples, Hitesh, that you gave, right? Uh, a lot of people know about Zepto story, but let me talk about Mokobara, right? When Mokobara Sangeet Naveen started, they started a travel business in 2020, which was in middle of COVID. That's like the last business you'll start when people are not traveling, right? But it came down to founders. Like it was not about is this business relevant today or not. The question always was that is this brand, is this business going to be relevant after 5 to 10 years? And they took that bet, and we took a bet on them, right? And that point of time, if it's a consumer brand company, over the years we have realized that a founder who's obsessive about solving for their customers, solving for the brand, is eventually kind of ends up making it big. And look, we kind of all of us got lucky to have met Sangeet so early in his startup journey. If you look at again Adit, right? It was unthinkable of solving for quick commerce in 10 minutes, especially after I think in 2000, from 2010 to 2021, there are at least like 35 startups in the grocery FMCG space. Out of them, I would say 95% did not work out. And somebody dared. I remember in 2021 when we first met Adit, he was talking about that he wants in 10 years he wants to become as big as DMart. Right? He's probably gotten close to that in 5 years. Right? So it's of course that aspiration, that's out of the box thinking, extreme resilience that matters. But he's always been at it, and it's always also not just the start of the idea. You need to keep having that 0 to 1 mindset every single year. Going even if you look at someone like a Zomato today, right? Zomato has a 0 to 1 mindset even today after getting listed. This is why they are so valuable today. So I think what is more, that comes back to the resilience in founders, that you're always looking at opportunities 0 to 1, 1 to 10, and 10 to 100.
Yeah, so mindset, execution, speed, agility, adaptability. I mean, that is what all makes the difference. So great story. But of course, not everyone is a Zepto, right? I mean, just like in the school days, you know that Ankit cannot hit sixes.
Uh,
So what's the biggest mistake, I mean, the founders make while chasing funds? I mean, we all talk about the success stories, right? And if you had to give one golden advice to entrepreneurs listening right now to you on this podcast, I'm sure a lot of startup guys would be listening right now. What is that one biggest mistake founders make while chasing funding?
I think for me, the biggest one will be listen to your customers before you listen to your investors. I think if you listen to your customers, whether it's a B2B business or a B2C business, you'll know everything how to shape up your business. And what we unfortunately sometimes see is business models are tracked, built based on the kind of funding that is available in the environment. We often say that there's a 2021 startup model and there's a 2023 startup model based on the kind of funding that's available. It's understandable because sometimes supply of capital drives the kind of funding that's available in the market. But if you want to run long run, uh, the funding can keep coming and going. We have seen enough examples now that ultimately is somebody just thinking long term about the true value creation of their customers end up surviving. So it all sounds cliche, but I think that's always the holy truth for us.
Yeah, so I mean, focus more on your business. Funding winter can come anytime.
Absolutely. I think one thing is for sure that given we are very blessed to be in a country like India today, that supply of capital is absolutely not a problem. That it's actually VCs and supply of capital which are chasing entrepreneurs and not the other way around. If you are a great entrepreneur, if you have a great business, there's no doubt of capital.
All right, so Ankit, my phone number is there with you. But anyways, I mean, so funding is just a milestone. I mean, it's not a destination for sure. It's just like passing maths. We used to think was the destination, but real life is what it is. I mean, so jokes apart, I mean, once startups hit the public market, investors often get confused. I mean, how should they look at these new age companies? And specifically, I'm coming over here to the new age IPOs that we keep coming. And that, I mean, and people often say that, I mean, these are coming at such crazy valuations, and maybe some investor is exiting out of it. I mean, and you really do not have direct comparables in many cases. So, how should investors think about new age startups that are listing today?
It's a heavy question, Hitesh, and I'll give a slightly longer answer to this, right? Every capital that gets invested, right? You either think about if you just zoom out, right? Either you invest in your own business, right? Or you are investing in somebody else's business. Whether you're doing debt or equity, if you're putting money in FD in a bank, that essentially also goes into somebody else's business as a loan, right? If you're investing in equity, that's also going into some business to finance equity for growth or some smaller or larger company, right? So that's how investors typically look at diversification. That I'm looking at debt or I'm looking at equity. But another way to look at diversification is the kind of company that you are essentially backing, right? For example, if you look at public market, classically you think about it's a blue chip companies and mid cap companies and small cap companies, right? Another new way to look at backing companies: are you backing the companies of tomorrow? Today, companies which are relevant today and which have been relevant for 40 years back may not be relevant, especially in the day of AI today, 10 years later. But today, the younger companies are going to be the large billion and trillion dollar companies of tomorrow. But does it mean that you put all your money into startups when they get listed? Absolutely not. My personal view is that based on somebody's risk appetite, you should definitely have some exposure. Every time you think about a new asset class, you understand it well and start with some exposure, right? Once you're comfortable with the volatility, the progress and risk and return of that asset class and the underlying asset, that's where you start calibrating how much money you want to put in. To specifically answer your question, if today there are 25 listed companies on NSE, in that case, I think the right way to, you're anyways having some exposure because the amount of money you're putting in mutual funds, all the smart mutual fund managers are eventually putting money, some allocation to these companies as well. If you want to put some direct exposure, start small. Maybe start with, let's say, 5% of your wealth into new age companies. In that case, if you feel comfortable, then you can increase your exposure. One way, more evolved, better way to actually start taking exposure into startups is by directly investing into funds, by investing into fund managers who do this day in and day out. So either you can invest into a venture capital fund who essentially will take bets into 50 startups who do this day in and day out, or you can invest into a venture debt fund where they diversify even more, where the returns are a mix of fixed income and equity upside, where they invest into 200 plus startups. Once you invest into a fund manager, you understand the risk and reward that comes with a certain underlying new age startup. That's where you start kind of doing a little bit more and start taking more direct exposures.
Right. So I think he has put in a lot of valid points. For example, I think 10 years back, all of us used to go to our grocery store and buy the regular stuff. And that is when maybe a DMart used to make sense for you for investing. But today, I mean, if you are ordering everything on a big basket or a blanket or a Zomato, then obviously things are changing. And hence, you need to be very cognitive of the fact that maybe these companies are the ones who would rule the future. And as well as what Ankit said on the later side of the answer was that you need to know your own risk appetite. I mean, if you are testing the waters, then start small. First, dip your leg, I mean, dip your feet and understand the dynamics of this business. Have a proper risk allocation in place so that you don't end up with a bad experience. And as he rightly said, that if you don't understand this stuff, then perhaps give it to a trusted fund manager who does this for a living and who would end up doing a better job than you. So I think you guys at Alteria are also raising capital. So maybe if you can talk something about it, Ankit.
Sure. So we are a venture debt fund. It's a very unique credit fund where we actually invest extremely high growth, high performing startups. We have a very diversified strategy where we invest into across sectors, across stages, starting from Series A. We backed 250 plus startups, deployed close to 8,000 crores in last 8 years of existence of Alteria Capital. And we are one of the very few funds in the country where we have fully raised domestic capital and when investing right back into domestic startups. So somewhere we are preserving the domestic capital and the money going back into domestic startups and promoting entrepreneurship in India. And most of our investors are large family offices, HNIs, banks in the country. And through our fund, they find a segue to get an exposure to startup ecosystem without taking outsized risk, and they get a flavor of the ecosystem. And at some point of time, they feel comfortable to start taking direct exposures as well. So these are interesting ways to start creating diversifying into both debt and equity, as well as diversifying into the kind of underlying companies where your money is going into.
So Ankit, on a lighter note, can I ask you one question?
Sure.
I mean, when you go and approach a big family office guy who has already made it, does he ask you कि भाई कितना बनेगा?
That's the first question. Also depends on which city you are going to. Right? So I think yeah, that's a. I think 10 years back when we used to talk to our investors, we used to find it tougher because the awareness, the track record of how well startups have done in India was very limited, and it was all a pitch. Thankfully, today with the track record of our ecosystem, track record of what we also do, it has become much more easier. Most of the large startup names are very household names, especially with for large family offices. The second generation, third generation are even more aware as they think about diversification. They also want to just be closer to the innovation economy, not just from returns perspective, sometimes also from their own business perspective. That a lot of our LPs want to invest in us because they just want to be closer to the innovation ecosystem because the business they are into itself is getting disrupted, and they just want to be very close to what's happening, what's changing, so that they're always aware about how to handle their own business.
Perfect. So wonderful insights, Ankit. I mean, now let me ask you a question on a personal note. And I mean, you have helped startups raise money, and they have gone on to become big names, and that is what people know you and your company for. But let me ask you one personal question about how does Encambo, I mean, so for the audience, I'm telling that that's what we call him personally. So how does Encambo manage his own funds? I mean, do you actually follow goal-based investing? I mean, why should even a successful entrepreneur like you have a financial advisor, or do you have a financial advisor?
Sure. Yeah, if I say something, you won't believe this, but I've had this conversation with a lot of extremely successful large money managers. That when it comes to their own money, everybody's excited. Right? Nobody's thinking it that deeply, and most people don't initially end up using a financial advisor. It's because you always think that if you can manage somebody else's capital, then why should you need to trust somebody else with your own money? But the truth is, look, for example, I back startups, I give them debt capital. And when it comes to my own personal diversification, I'm not an expert at it. Right. And which is true for, I think, most of the financial money managers that when it comes to your own wealth, sometimes you just need a trusted person who does this day in and day out. So I have moved from, some holding 80 direct stocks 10 years back to probably owning like 15 direct stocks, owning some 30 mutual funds to 15 mutual funds, and using more advisors to manage my own wealth. One is I typically don't end up spending that much time in managing my own wealth. And second thing is I would like to, the way people are trusting their money with me In the same way, I try to trust my own money with someone else because they're experts at it.
मतलब डॉक्टर खुद का इलाज तो नहीं करता है.
Absolutely.
So I strongly believe, guys, that even the smartest people need an advisor. I mean, just because the startups need a board to guide them. Similarly, individuals need somebody to guide them and stay disciplined in this entire journey of investing. So brilliant, right? So from pocket money to samosas to we didn't talk about haircuts and girlfriends. What a journey this has been. I mean, to venture debt, and what excellent work you guys are doing. So thank you for not revealing my end of embarrassing stories
For the
to
next
the
series,
audience.
maybe.
Maybe we'll keep it for some other day. But for all the listeners, this was not just the friendship part of it, but this was actually a finance masterclass. But I know many of you keep thinking about how do you go and invest into these startup ideas. So there are so many ways. I mean, people look at unlisted shares, people look at a lot of AIF structures that are present in today's market, whereby you can invest into some of these best ideas at a very early stage. So, I mean, just like Ankit manages this fund at Alteria Capital, wherein you can look at doing venture debt investing. Similarly, there are a lot many other funds which are available with the other manufacturers who kind of specialize in venture equity investing as well, right? So fair enough. So Ankit, thank you. I mean, इतना सारा कुछ पूछ लिया, but बाकी questions शाम
I
के
think
लिए
we can
रखते
go on and on.
हैं. But बाकी questions शाम के लिए रखेंगे. But thank you guys for listening into this podcast. I'm sure this was a very different take to what you've been hearing all this while. This is something new age. And I really hope that this podcast actually goes out to all these startup entrepreneurs who are aspiring to make big. And when they listen to experts like Ankit, they would know what to do next. So thank you so much, Ankit, for coming over to this show. And I look forward to hosting you again
Thank
in
you,
future.
Hitesh. It's been a pleasure.
Thanks.